thanks for having me. Thank you, Nir, for the introduction. So it's a pleasure to be here. I just realized that the next Bitcoin halving is sort of just a few hours away, probably. So the halving of the miner rewards. So this is a fortunate coincidence. So it's great timing to talk about Bitcoin. So today I'm going to present to you ongoing research on international Bitcoin flows. This is joint work with Raphael Auer and Jan Paulik. So Raphael is the head of the Bank for International Settlements Eurosystem Innovation Hub, and Jan works there as an advisor. I'm with the BIS in Basel, as Nir mentioned, so this is the parent company of the innovation hubs, if you will. So as always, the usual disclaimer applies. These are my personal views and not necessarily those of the BIS or its innovation hub. I would also like to add that as a personal disclaimer, I'm a principal economist in the monetary and economic department of the BIS. So my background is very much with traditional financial systems, in particular banks and investment funds. So it's actually through a joint project on examining banks' exposure to crypto assets that I started looking into the crypto ecosystem. But I have to fully admit that I'm still on that part of the learning curve where the first differential is really, really high. So let's get started. Now, the question is from a policy perspective, and that's sort of the perspective we take on here at the BS. So what brings us to studying international, or more specifically cross-border Bitcoin flows from a research, but also from a policy perspective? And I brought you this quote from a 2023 BIS paper from the Consultative Group of Directors of Financial Stability in the Americas, which basically summarizes, to some extent at least, the policy view shared among many public sector institutions. So arguably, crypto was pitched as a near perfect solution to many of the challenges of the financial system, such as the lack of financial inclusion or high inefficiencies, given the legacy infrastructures that many of the traditional financial institutions use, or simply protection of the margins of the incumbents. But at least up to now, these benefits have not materialized, or at least not materialized at large scale. And this group then concludes that the crypto assets may have even amplified financial risk. So in essence, the concern is that we have a very opaque ecosystem that is formally fully transparent, but essentially very obscure, with limited or fragmented regulation today. So importantly, rising institutional participation, so fostered, for instance, by the introduction of Bitcoin ETFs, if you think of the case of the US, will tighten the interlinkages between the traditional financial system. And while in the past, what we've seen is that usually when there's a big crackdown in Bitcoin prices, that this had a very modest impact on financial markets, this is not necessarily a given going forward. And finally, there's a concern that capital flow management measures, or CFMs in short, and financial sanctions could be easily circumvented by the use of crypto assets. So in short, there is significant uncertainty about the flow of crypto assets, its underlying drivers, and the potential risk associated with that, which have fueled a lively debate, including among macroprudential authorities, many of which are represented by central banks, or at least linked to central banks. So our paper tries to contribute to this discussion in a few ways. So first, as you'll see in a moment, we'll construct a network or map of bilateral cross-border Bitcoin flows, and we'll take first stab at assessing the underlying drivers of these flows. And in particular, we'll try to draw some comparisons to traditional financial flows, such as interbank credit or remittances. And then we'll study the impact of CFMs and sanctions. So to give you a little bit of a summary of the findings, and I have to mention this is work in progress, so any comments, any feedback is extremely welcome. So first, and possibly not very surprising to this audience, the Bitcoin network has grown significantly. By the end of 2022, the network that we estimate spans 84 countries with a strong emerging market economy footprint. And among the EMEs, we find a big shift in activity over the span of our period of observation. Second, there is really a varied mix of potential drivers, which we interpret as suggestive of a varied use of Bitcoin. So I'll be showing you that physical distance, as you'd expect, plays a diminished role if you compare it to the role it plays for interbank credit or remittances. But our findings also suggest that there's an important role for global factors, which would be consistent with using Bitcoin primarily as a financial asset or for investment or speculation. And then we find that national drivers that track domestic currency weakness are also associated with larger cross-border flows. And then bilateral interlinkages, such as proxies for informational frictions, also play an important role. And last, on the policy impact, we actually do find that CFMs appear to have some grip. So we find that a tightening of CFMs is associated with reduced cross-border Bitcoin activity. And so are financial sanctions, although not for flows between crypto exchanges that are considered to impose only light know your customer restrictions. So I saw that there's a hand popping up. I can take questions just now. I'll do my best to answer them in a concise way.
Yeah, sure. Yeah. Dalia will promote you, so you can now feel free to interrupt.
Yes. So, hi, I'm Dalia, and I apologize in advance. I'm the non-economist in this audience, maybe not the only one. But I just wanted to ask, when you're referring to these activity measurements, what are you measuring? Endpoints, mining, software development, other services, intermediaries between my wallet and Bitcoin? What exactly are you measuring, in which countries they're present, and so forth?
So if you bear with me a few slides, then I'll come exactly to that. So at the end of the day, what we're trying to measure are transactions between wallets that can be linked to crypto exchanges. And we piggyback on a BIS Innovation Hub project called Atlas that is designed exactly to help us start monitoring these flows across borders. But I'll get to that in detail. So if you're not convinced after those slides, then please feel free to interrupt again and ask. But it's yes, it's obvious. And spoiler in advance, it's a proxy, right? So it will not be an exact measurement. I'm fully aware of that. But yes, thanks for that question. Okay, so here we go. So so if you look back just a couple of years, it's fair to say that the literature on crypto assets basically exploded. And not even going to try to leave the impression that I can comprehensively summarize the most recent contributions. It is, from our view, actually, it's worth noting that the number of empirical papers from the public institutions, actually, they have increased most recently as well. So when I take this as an indication that the interest from a public policy perspective, in particular when it comes to empirical analysis, has remained very strong. Okay, so let's finally get to the measure, or what we're trying to measure. So the starting point, as I mentioned, is this project that the BIS Innovation Hub at the Eurosystem Center initiated, Project Atlas. And the objective of Atlas is to create a data platform that sheds light on the macroeconomic relevance of crypto assets and DeFi. So as part of the first proof of concept, Atlas derives crypto asset flows across geographical locations. So what does that mean? So the approach is to use transactions and attribute these to crypto exchanges in the Bitcoin network. So we're going to look only at on-chain activity. And along with the location of those exchanges, you have a proxy for cross-border capital flows. Now, this comes with many challenges and caveats, and two of the main challenges are that some of the exchanges, including very big ones, cannot be allocated to a specific jurisdiction. So you would not know where to put Binance, for instance. And some of the exchanges are in offshore locations, so like the Seychelles, and those would be a very poor proxy of user residence, so where the flows come from. So what we're going to try to do, so try to take this one step further, and we're going to try to start from the exchange to exchange flows that we get from the Atlas platform. And so this gives us the dollar equivalent of daily flows between 253 exchanges, including within exchanges. Again, this is based on the typical way that wallets are trying to be using heuristics and cluster analysis allocated to these exchanges. So for the within exchange activity, we drop the top percentile of daily flows to mitigate against the risk of picking up wash trading. And we also do, and we will do, once the paper is finalized, robustness checks on adjusting for or applying more stringent exclusion criteria. And then what we do is that we map these flows to measures of crypto exchange usage. So the data that we're using come from Sensor Tower, and you can find a more detailed description in one of Raphael's BIS working papers. So in a sense, we have a simple count of the number of active users by country. So we have to be clear, this is not a monitoring device. So it's just a simple count. For example, you would see that in December 2022, for instance, have the number here, there were more than 5 million users that logged into Coinbase, the Coinbase app from the US, and around about 740,000 from the UK. So with these, we will try to build up, country weights. So in total, we have usage numbers that increase to up to 100 million counts per month over the observation period. So, and then based on this, we construct country weights, which we weight by GDP per capita to account for differences in the wealth of users, or the average user across countries. So basically, this would imply that for US user, the weight is about 23 times higher than that of a user coming from Nigeria. So this is the formula basically. So it's really simple. So you take the active users from the US that are in Coinbase, for example, or here we have another example. This would be from Binance. You would calculate the share of users that are allocated or that are associated according to Sensor Tower data with a particular country. And that you can do for each of the exchanges to the extent that they're being tracked by Sensor Tower. So basically, in our case, that is for more than 250 exchanges.
Can I ask a question?
Sure.
So I think for a lot of these geolocation data in these contexts, a lot of people use VPN. I think more in the US than maybe in Nigeria. How, in what directions would this scale to would this bias the results, or would this be more conservative estimation, or? So
there are two answers. The optimistic answer to that is that a priori there's no reason to believe that the use via the apps would be systematically different than usage through other channels, unless you want to hide the country of origin. So one of the caveats, for instance, is that our tracking of activity from China is relatively low. I've talked to Chinese colleagues here, and they, to some extent, this is in line with the Chinese authorities taking a much more restrictive stance on Bitcoin throughout or increasingly restrictive stance during our period of observation. The other less benign interpretation would be that, well, maybe our measure is failing to track people that find other channels through which they can use these exchanges. So it's a proxy, and this is basically as close as it gets, but we're still convinced that it's better than using the location in which the exchange is headquartered. If you look at the country weights, they sort of lined up with what we expected to find. So there are no clear outliers in terms of very weird, so to say, country weights for the exchanges that we have. Okay, so the final step then consists in assigning flows pro rata to the countries based on the weights of the sending and receiving exchanges. And I was expecting Dalia to get back to me, but I'm going to finish this slide and then we can have a discussion on this. So basically the approach is very simple. So what we would have is that you have a country weight for both exchanges, and then as a pro rata, you can basically apply these two country weights to construct a proxy of the flow from country I to country J in any given time. And what we'll do for the analysis is that we're going to aggregate these flows at a quarterly or annual frequency to align them with the available frequency of other cross-border flow measures that we want to compare them with and our control variables. And we're going to do that, and our sample is going to be from 2016 to 2022. And now I'll try to answer the question.
Yeah, so I don't think I can turn on video anymore, but I do have some concerns about the method. I understand you're doing the best that you can under this platform, but two things come to mind right away. First of all, unlike flows across borders between banks, there is no travel rule compliance or anything like that in Bitcoin. So actually, the more activity I have as an exchange, the less you will see on chain, because it will net and wash, as you said. And secondly, I would assume that you're not tapping into the exchange, you're just watching activity on chain. So I don't know which addresses do you attribute to Coinbase, but Coinbase, for example, but Coinbase will have much more addresses, Bitcoin addresses, than what they publish, which they use for their internal bookings. So there's a lot of things that just don't carry to the Bitcoin blockchain from the traditional financial world that I think this method of measurement might be glossing over. I also want to apologize. I have to jump at the hour for a faculty meeting. So it's nothing about this talk. I just have to jump.
So actually, I would like to draw an analogy to the banking world. So what we see there also are these single dealer platforms, as they're called, and they do something which is essentially very similar, right? So as, for instance, you take the single dealer platform of Deutsche Bank, you try to net out and aggregate flow so that the net amount of flow that you have to bring to the market will be much smaller than what you see. So you're absolutely right. So in some sense, this is the remaining net activity between the exchanges, to the extent that you trust in the allocation of the wallets. It's true that whatever happens within is very difficult to track, and we're also not observing what is happening off chain. So if you think of the papers from Luckner and Reinhard and Roger, for instance, so they look at local Bitcoins. So this off-chain activity, this is something which is completely outside of what we see. Still confident that at the end of the day, if you look at the net transactions, even though it doesn't give you the complete picture, it does give you some sense of the way the flow is, or the direction in which the flows are going. Again, so this is a first step in a long journey in trying to improve our understanding of how these flows come out at a global level. And any suggestions on how to improve it are extremely welcome.
Yeah, fair enough. Thanks.
So this is then what the map would look like. again, with all the caveats in mind. So you probably should think of this more as a map as at the time when Columbus was sailing to the west. So the borders look pretty clear, but there are caveats around our ability to measure this with accuracy. So our network, as we would get it out of our measure, would comprise 84 countries in total. So you would have up to roughly 7,000 directional flows. And what we do here is that we plot the bilateral flows over $150 million aggregated over 2022. And the fat arrows would represent those flows that are above 1 billion. And the colors in the map, they indicate the total amount of Bitcoin sent across borders for each of the countries. So based on this, the major players are the US, but also major emerging market economies such as Brazil, Russia, or Turkey. We dig a little deeper into the network characteristics. So what we see is that the top 10 bilateral flows have changed a lot from the beginning of our sample towards the end. So at the beginning, I'm not sure if you can see my cursor moving. At the beginning, we have a lot of activity that we record that is related to China. And China, for our measure, has completely dropped off the list. And this goes back to Kite's question, whether this may be due to people finding other ways than via the apps to access the exchanges, or whether the restrictions that have been imposed, not only in mining, but also on usage of crypto, or Bitcoin in this case, have proven effective in China. We can also aggregate the flows across countries. So if we want to have a look at the top senders and the top receivers, what we see is that the top senders are very equally distributed, but from a receiving perspective, a lot of the flows that we measure, they're sort of directed towards the US. Now you could argue that part of this may reflect the GDP weighting. That is true, but if we take out the GDP per capita weighting, we would still see that the US is the top receiver with about 15 billion then in that measure. Our overall volume is in 2022 was 100 billion US dollar, or equivalents of US dollars that we can measure. Again, if you put that into perspective, there's an ECB paper which puts the on-chain activity at roughly 400 billion during that time, so would be capturing a quarter of the on-chain activity. There are papers out there saying that the off-chain activity is much larger than on-chain. Some argue that it's about equivalent. So it's really difficult to say what the coverage of the overall activity is, but this is sort of the angle for which we can assess the flows.
Can I ask a question? So,
Sure.
So two things about one before. So I think maybe, I don't know if you have something, but maybe the 2016 movement related to the change in the mining industry in China. There was a shipment, I don't know when, maybe Dalia knows, that I think they put a lot of regulation on miners in China, and then many miners stopped working on China. So I can think about that when they could mine there was much more activity than after the regulation.
Yeah, so my co-author Raphael has a paper together with Stein Claessens where they look into the impact of regulation. In the other working paper that we have on the exposures of the banks, you also see this big drop-off in Chinese activity. I must confess, I'm not sure it's 2016. I thought it would be 2018, but to be checked. So Next time I present, I will have the number for you. Absolutely.
Okay. No, I think like it can partially explain why maybe somewhere in the middle there was this changement and this kind of shift.
Yes, absolutely. And that would speak in favor of our measure. At least that's how I would spin it. It would be picking up the decline in activity. So if we turn to the drivers, then take a short step back. The question is, okay, what are the kind of drivers that we would be looking out for? And one question there obviously is, so what are the use cases? So when the way we think about this is that first there's a lot of talk about crypto or Bitcoin as being a new financial asset class, and there will be there's an incentive to go in for speculation or search for yield, but also hedging and diversification. So really this investment angle. And this would suggest that what we should be looking out for are global drivers of these transactions, because these are factors that should be driving interest across the countries in a similar fashion. And there's also a great JF paper by Liu and others considering crypto risk factors. The other point of view is that, okay, now Bitcoin was intended to be a transaction medium. So in terms of cross-border payments and financial inclusion, we should be looking out for national factors that would explain the usage of Bitcoin. There can also be, and there have been papers on this mentioned in the related literature, like Foley and all, and Hugh and all, that this is driven by illicit transactions or the intention to circumvent public sector controls. And again, so this would be something that we would be hoping to pick up in country-specific factors. Or there are bilateral linkages, such as informational frictions, for instance, that you will also be able to tease out. And here, one of the nice aspects about the data is that it really has this bilateral dimension. So we can really see country-to-country flows to the extent that you consider the proxy accurate. In terms of the empirical approach, so what we want to do is that we're going to nest this into a standard gravity model. So this is something that people use a lot, for instance, in the international trade literature. We will be looking at the bilateral flows in a given quarter, and we'll be looking at the US dollar equivalent of Bitcoin sent from country I to country J. And this setup allows us to control for time varying characteristics of the sending and the receiving country. And we assume the usual functional form for bilateral frictions that will allow us to assess the impact of distance, for instance, but also of other bilateral measures that we could think of, such as the cost of remittances, if we want to draw a comparison to the traditional finance. Our approach is based, again, relying on a large literature, the Poisson pseudo maximum likelihood estimator, PPML, and we will saturate our models or specifications with the maximum amount of fixed effects to take account of these multilateral resistance terms. We'll have a look at a variety of flows and controls. In the interest of time, I will not go through the different controls. We'll look at them as we go through the estimation results. But a few words on the flows. So here are some summary statistics on our flow measure. If you consider all cross-border Bitcoin flows in million, we have an average at the, so this would be a country-to-country flow in a given quarter. It would be around $2.85 million. We also have a look at what we refer to as Know Your Customer Light flows. So these are flows between crypto exchanges with limited KYC enforcement, following the paper in Makarov and Shor. And these flows are somewhat smaller, but still significant. And then when we try to compare this to flows, or try to compare this to remittances, we'll be looking at flows that have a low denomination, so below $500 or below $200 in Bitcoin equivalent. On the other side, we also have traditional finance measures, so interbank claims, for instance, from the BIS banking statistics. Here we're looking at start measures. So these values are much higher, as you would expect. So the average claim of one country on the other is of banks in one country on banks in another country would be around 4 billion. But there's a heavy skew, obviously, because some of these interlinkages are really large, and many of them are non-existent. Then we have remittances, which are also an order of magnitude larger than the Bitcoin flows, and then exports. The remittances we can only estimate at an annual frequency, so this will limit the frequency at which we can compare these to the Bitcoin flows, and we follow the procedure that the World Bank applies with double weighting of GDP per capita. So we'll start off very simple with just basic gravity controls thrown into this, but using the full set of possible fixed effects. And what we see here is that if you look at the distance effect, then clearly, as you would expect, physical distance matters much less for the Bitcoin flows that we measure, but it's not insignificant. So the elasticity declines from minus 0.6, as you see it from interbank credit, to about minus 0.2%. So the Bitcoin world is not completely flat in that sense that geographical distance does not matter anymore. But relative, as I mentioned, relative to interbank credit, and as you will see later on, relative to remittances, the impact is much diminished. Somewhat surprising finding for me is that if we look at the effect of common language, then we see still relatively strong impact. So two countries sharing the common language, based on our estimate, if you take it at face value, would have almost a third higher amount of cross-border Bitcoin flows than countries that do not share a common language. So we'll try to investigate that in more detail. If we turn to global factors, there are also some very.
Can I ask something?
Yes, absolutely.
So, I think that in some sense, when I think about the gravity measurement, I feel that in some sense, like if we think about the alternative, if people use it as a overboard payments, so maybe kind of you want to find a connection to the opportunity, like the alternative opportunity. And I guess that sometimes even the distance between UK and USA is big. Maybe it's the alternative is relative cheaper or whatever, or costly, and maybe it's more about, like, if you want to find a connection, it's more about when the alternative is very costly, then you're going to use it even if it's between Mexico to USA, for example.
Yes, exactly. So that's why we will be looking into the cost of sending remittances as a comparative.
Okay.
Exactly. I think what the distance tells you is that you cannot reduce Bitcoin usage just to speculation, global speculation or whatever. There is some, and that I would see this as a parallel to the von Luckner paper. There is some real activity that is also paralleling or mirroring the activity here. So just as distance explains trade flows to a significant extent, we find something similar here, even though obviously the transaction costs, right, in that sense, they are much lower.
Mm-hmm.
So yeah, I think it really brings about this link that we cannot investigate based on our data, but that is out there and that has been studied to real economic activity. So when we turn to global factors, something that we find is that the VIX has a positive impact on the transactions. So usually people think of the VIX as a measure of fear, which would reduce activity. But here we have a positive effect, and given that it's log VIX, you can interpret it as an elasticity. So 1% increase in the VIX here is associated with more than a 1% increase in cross-border Bitcoin flows. So if you were to push this to a 1 standard deviation increase in the VIX over the period of a sample, you would get an increase in flows of around about 12.5%. And the findings in the ECB paper by Di Cazzola and others, and the recent IMF paper by Eugenia Cerruti and others, they have a similar finding for VIX. So the Cerruti paper interprets this as a shift from traditional risky assets to crypto flows. However, if we look at the volatility of Bitcoin directly, which we have down here, we also see a similar positive effect from higher Bitcoin to US dollar exchange rate volatility on the Bitcoin activity. So it really seems to be linked to, if you want to say, a speculative motive that higher volatility in markets provides greater opportunities for short-term trading. So this would be something that might be picked up in these two coefficients. On the other hand, if we look at variables that have been used to proxy for a tightening of global funding conditions, like the broad dollar index, and here this is the effective US dollar exchange rate vis-a-vis 58 countries, where an increase would imply an appreciation of the dollar. We see that a dollar appreciation leads to a decline in the flows. And this is in line with dollar appreciation implying tighter global funding conditions, which acts as a constraint on market participants. We have a similar effect for the BBB credit spreads. Here we're using the option adjusted spread, also implying tighter funding conditions. Now on global monetary policy conditions, we look at changes in the federal funds rate. And here we estimate that for a 100 basis point increase, you would observe a 60.7 reduction in Bitcoin flows. So for the typical 25% basis point hike, this would amount to roughly a 4% decline in cross-border activity. And similarly, higher growth in the US, which we use as a proxy for global growth, then global is associated with the decline in flows. However, we also checked whether our flows would load on the crypto risk factor that have been developed in the 22 JF paper of Liu, Sivinsky, and Wu, which is based on more than 1,800 coins. And one observation here is that the inclusion results in an insignificant loading of the US policy rate. So my take on this is that the crypto-related return factors dominate those associated with more traditional markets. We're really at the beginning of this, so it's quite difficult and challenging to interpret these coefficients on the crypto risk factors. Now, one interpretation that the authors there have, Liu, is that you could take the size factor as a gauge of the liquidity premium, and momentum they pitch as a measure of investor overreaction. So our best interpretation here, given that we're using lags, is that you would have a reversal in momentum and a reversal in the liquidity premium, knowing that Bitcoin among the coins that they're using is one of the most liquid. If we move to the country's perspective, we now have the advantage that we can differ between the sender and the receiver view. So here we're showing semi-elasticities, and something that has been argued in favor of the use of Bitcoin is that if you have a weak domestic currency, so you have a lot of FX volatility, you have high inflation, this would, Bitcoin would provide to you an alternative channel for transactions, or maybe even for a store of value, although given the high volatility of Bitcoin prices, it's difficult to see, at least in most countries, how the store of value motive would feature here. We do find that actually both for the sender and the receiver part of things, that higher inflation and higher FX volatility, here measured vis-a-vis the dollar, is associated with a greater use of Bitcoin cross-border. We also see that higher domestic growth is associated with higher flows, which, if you want to make the link to the usage as a medium of transaction, makes perfect sense, because here you would see that greater economic activity, so a greater need for transactions to mirror this, are equivalently reflected in greater cross-border activity in Bitcoin. We also have a measure of Bitcoin awareness based on Google searches of the term Bitcoin. So this is an index that goes from 0 to 100 for each country. It's a measure that is relative in time within each country. So if the Bitcoin awareness increases by 1 point, what we observe is roughly 15% increase in the sending country, or an 8% increase in the receiving one. So here the link is less obvious. So is this something where people step into the market because of for instance, great returns observed in Bitcoin? So I'm always struggling to tease out what exactly the Google searches will be measuring, but it aligns with the literature that also finds this positive effect of Bitcoin awareness.
I have a small question. Maybe it's just like, so I see that there is like different with one number between sender and receiver, but in general, the data, it's mapped 1-to-1, right? Every time that there is a sender, there is a receiver, yeah?
Yes, that is correct. So as a receiver, but you will be receiving. So the one perspective is, if you are a sender and you come from a high inflation country, are you more likely then to use Bitcoin transactions cross-border? And the other is, if you are a country that is experiencing high inflation, how does that affect the inflow of Bitcoin? So that is the sort of the change in perspective. But you're absolutely right. So we're looking at a closed system in the way we define it. So the sum of Bitcoin sent will equal the sum of Bitcoins received. And these are separate regressions, where in terms of the fixed effects, either we sort of mop up the receiver side when we look at the sender based on receiver time quarter fixed effects and sender fixed effects. We cannot obviously not have both interacted with time fixed effects, or we turn around and look at the receiver side, where we would then impose sender times quarter fixed effects to take out the variation that comes from that side.
I see. Yeah, makes sense. I think like it's just because when I look at the number, it seems that maybe you have one missing sender observation.
Oh yeah, that's actually true. Yes, I will have to look up on that. Thank you.
Yeah, no, I think it's it's not really matter.
That could come from the fixed effects, though.
I see. And just again, it's after you doing the control that the big exchanges, you kind of try to get weighted by country method, right?
Yeah.
I see. Interesting. Makes sense. And do you know there is any country that is dollar reside in your data?
that has dollarized
Yeah,
its currency. So where you would take out the FX volatility
it's
component. Yes. So we checked for that. So El Salvador, for instance, is one of these effects. Taking them out does not change.
Okay.
So the results are robust to that. There are fairly few countries. Interestingly, El Salvador is one of the countries that actually introduced Bitcoin
Yeah.
in parallel to its to the currency. So this is definitely something where we could dig in a little deeper. But the short story is that yes, so it's robust to taking out countries that have, by definition, no FX volatility vis-a-vis the dollar.
Interesting. Yeah. Okay. Thanks.
So something we also want to get at is if you consider informational frictions, which are a key factor actually in the gravity literature, in particular when it's applied to financial flows. And the ability to overcome these frictions has been associated with greater transactions in, for example, equity, as shown in a 2001 ER paper of Portis, for instance, and others. And here we propose a new measure based on using interbank claims from the BS banking statistics. So we would like to take, so we take the stock of claims of banks in country I on banks in country J, and vice versa, and then we divide it by the total stock of interbank claims of these two countries. And this gives us a measure of the relative importance in the interbank market of the other country, of this interbank linkage of this country pair. And so since banking is a relationship-based business, we use this as a proxy of the extent to which informational frictions have been overcome in traditional finance, so in the traditional financial market, for each of these country pairs. And what we see here is that for the Bitcoin flows, actually the interbank linkages index loads. So there is, if you go with me and accept the way we try to proxy this from a traditional financial angle, there is also this parallel in the Bitcoin flow measure. We do not find it for trade interlinkages, so you can do the same for exports, and there's absolutely no correspondence here. There is obviously between interbank linkages and exports, given that a lot of the export financing comes still through the global banking sector. So there is this disconnect, if you will, from the international flow of goods, but there is still this link to the global flow of interbank credit. So in the interest of time, I'll try to hurry up a bit. Bitcoin has often been pitched as a solution to overcoming the very high cost of sending remittances. Not only the high cost, but also the time it takes. And so a natural question to ask is, how are the cross-border Bitcoin flows related to remittances? And what we take from the World Bank is a measure of the bilateral remittance costs in terms of the percent of the transaction value, but also the number of hours or approximate number of hours it takes to send the remittances. And then we consider different variants of our Bitcoin flow measure. So first, the overall measure, where we find no clear-cut correlation to the cost of remittances. But when we zoom in on flows of smaller denomination, we do find that there's a positive association to the cost of remittances. And equivalently for remittances, obviously, as you would expect, there's a negative link. So higher cost of remittances are associated with larger low-value Bitcoin flows cross-border. And to put the numbers in context, so 10% increase in the cost is associated with a 4.4 increase in low-value Bitcoin transactions, according to our estimates. A policy concern, obviously, is that capital flow management measures would lose their grip if you can easily circumvent them through the crypto ecosystem. So based on a relatively new data set on capital flow measures from Binici and others who are at the IMF, we tried to test what happens if you have a tightening of capital flow management measures. Does it impact on the Bitcoin flows? And I was not expecting to see anything, but in fact, we do find that there is an impact that comes when you activate these flows. So to address endogeneity concerns, we look at lagged capital flow measurement activations. And just to keep it simple, so here we would have that if you have activated a capital flow that restricts outflows in the previous quarter, you would have around about 14% decline in the bilateral cross-border Bitcoin flows. Similarly, if you look at the receiving end and you look at capital flow management measures that restrict the inflow of capital, so we're changing the CFM measures that we're looking at here, you would see around about an 8% decline in measured cross-border flows. Another step is to have a look at sanctions. There are many sanctions in the global sanctions database that we consider, but there are very few cases where sanctions have actually been activated during the period of observation. So you should think of the measure here more as a non-time varying effect. We find an effect on cross-border Bitcoin flows for financial sanctions. But if we turn to KYC light flows, as mentioned before, this effect vanishes. So you could interpret this as one way in which some users are trying to evade these sanctions. If you turn to interbank credit, for instance, it's a very, very different story. So given the reputational risk associated for banks in being breaching sanctions, you have a very strong and immediate effect from the position of a sanction on the amount of interbank credit. So for the interbank credit, this would amount to about a 40% reduction in the stock claims. And then wrapping up, so what we do in the paper, as I mentioned, we try to map global Bitcoin flows, and we have a proxy of bilateral cross-border flows. It is clear this is a step forward, we hope, but it's evidently not the end of the story. It's not a perfectly accurate measure, but the characteristics of the flows, and if you link to the drivers, provide very intuitive correlations, I would say, that align with some of the priors that we would get out of the literature. And in particular, this variety of global, national, and bilateral drivers suggests that there's a multifaceted use of Bitcoin in cross-border transactions. It tallies both with characteristics that you would assign to the usage of Bitcoin as a risky asset, but also as a transaction medium. Now, traditional measures to contain capital flows like CFMs and sanctions that we've studied do appear to have some impact on cross-border Bitcoin transactions. We haven't looked into the channels, why this could be, because if you think of these CFMs, they're not targeted at crypto activity. They're targeted at traditional financial flows. Still, they could, if you think of the context, for instance, of one of the Makarov and Schroer papers, they could impact, or they can constrain the flow of arbitrage capital that supports these transactions. All that being said, still the risk of circumvention obviously looms in a very opaque ecosystem. And so the need to provide further transparency and also further measurement or monitoring capacities still remains. And let me stop there and thank you for your attention.
Thank you so much. So yeah, so I think we have time for 1 or 2 questions. So if someone has a question, feel free to ask. So I have two questions. First is, I guess like the Bitcoin ETF was a kind of a game changer. So do you thinking about looking on the data in the last few months, and what your point of view of how it's going to influence the market? And second is a side note is if you have any analysis about Lightning Network, which is the kind of off-chain transaction on Bitcoin, which also people may use it as a cross-border for transactions.
So I'll take it in reverse order. So we don't have any insights into the Lightning framework. Again, and going back to the previous question, I would see it as the exchange part of it showing the net flow that after the aggregation, because even in the Lightning, it's not completely outside the blockchain, right? So you have
exactly.
You have aggregators, but there is the residual net flow. So in that sense, even the on-chain activity may be picking up or is picking up some of this cross-border activity that can be linked to remittances. In terms of looking at what the introduction of Bitcoin ETFs means for the market, so first, this is an ongoing project from the Innovation Hub. So there's a continuous interest and continuous work on maintaining the data and looking into the developments. My personal hunch is that the biggest effect could actually come from changing the composition of the investor base, because the ETFs are opening up Bitcoin exposure to a much larger investor base that has very different constraints and comes to the market with much more of a traditional finance approach. So it could, if you think of, for instance, institutional participation, also change the dynamics of Bitcoin pricing and the dynamics of the market overall. But left to be seen. So I think it's for the Bitcoin ecosystem, it's a very exciting development that we're seeing here. From a public policy perspective, obviously the need for a sound regulatory framework is becoming ever more important if exposure to Bitcoin is branching out even further into the institutional investor base.
You see, yeah, makes sense. It will be nice to see the data. My sense is that it will even increase the USA receiving.
Very likely, yes. That's a super point. Yes, I would also expect that, but it's an empirical, not yet. Yeah.
Okay, thanks so much for everything, and and see you everyone next week, and that's it.
Okay, super. Thank you, Nir.
Thanks.